All right, let's go over some markets, over some trends. So over here, what you had was, this is very typical. You see this volume here, the biggest in 49 waves. That's really, really important. Why? Because that's your climax. That's your climax. That's your change of behavior. That's your higher high with a pullback test, but this was a counter trend. So typically they have very poor risk to reward, and you see it's a very little move. So what happened here was this higher high signal, it looked really good. It looked really good, right? Because if you take a look at the index, you see that it looked like a base, testing, and then breakout, and a pretty good breakout over here, right? 13 stocks rallying and all that. But you see again, you could have one picture on one time frame and another picture on another time frame. This move up went right into a prior resistance area, and that's why it failed, because there was a resistance area. So although on the lower time frame it looks like a breakout, on the higher time frame it's just a pullback to test a resistance area. And because of that, you have conflicting information. Higher time frame saying no, this is testing. Lower time frame saying, oh yeah, it's bullish, making higher highs, has stocks, big waves, etc. But it wasn't enough to overcome resistance, and from resistance there was some selling, and that selling was then later on bought, and they made a higher high. Yeah, but it's still near resistance area, so we have to see how this thing plays out. So that's the thing. If you have higher highs or low lows, but they go into key levels, you want to be very careful with buying pullbacks or selling pullbacks. Because of that specific behavior is going to mess things up. All right, that specific behavior will create problems. All right. It's conflicting, right? So that's about it. There wasn't anything else today. I know folks that when they saw this move down, they were like, let's short this right here, around this area right here, right there and even here. But what happened was the market absorbed it. So this really leads to one important fact. And if you understand this, the psychological aspect of trading will be very, 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 I should say very easy, but it'll be much less dramatic, much less painful. And that is, you cannot, what is it? I forgot how to word it, but the thing is, you cannot prevent losses. It is impossible to prevent losses in trading. It's yes, there are hedging strategies and all that. I'm not going to get into that, but the point is that if you cannot force wins, or you cannot prevent losses. It's basically the same thing, but the opposite of it. And but you can minimize them. And understand, as Wyckoff explained, this is a game of averages. So you have to accept the losses and you have to accept the wins, and just make sure that the averages, meaning the points lost versus the point gained, are favorable. So for example, here, if you see this higher high signal and you got in, you have very little risk. So it doesn't work. Okay. Even here, say you want to go short instead, you risk this candle, and if it works against you, you just lose that candle, right? But if you are right, you get a big move. You know what I mean? If you are right, you get a big move. So you average that loss with that win. And that's the only thing you do there. And this points to a deeper thing, and that has to do with causal thinking, like if this, if this, if this. And a lot of programmers and folks who are engineers, they have this type of mentality, or even normal. What you think is, if this, then this, then this, then this will happen. But that is not true. You see, like you see this selling over here. I could make the case. You took out the trend line. You had volume right here. See that spike? You took out the trend line. You had that volume. What else? Market's about to turn. Or, we give a lot of reasons. Look at the size of the wave. And all of that will lead you to say, okay, I'm going to definitely short here. Right? So this and this and this is making you think, you have a lower low, you have a break of the trend line, you have a price volume increase, you have a breakdown on heavy volume, spike right here. Clearly, that's a good place to short. But what happens? It gets bought and goes higher. So you see, these technical indications are probabilistic. They are probabilistic. So what probabilistic versus random is a little bit different. Meaning on one trade they're random, but on multiple trades they're probabilistic. It's a very important concept to understand that if you get this situation on 100 trades, chances are the majority of them will go down because of the trend being favorable, the lower low, the trend line break, the heavy volume break. It will be favorable. You'll at least get a move that's more than 2 candles, But on any individual trade, it's going to be random, as you can see clearly over here. Imagine you have a trend line break, heavy price volume action, heavy break on volume, and a number of stocks, the most here on the downside. See, that's the biggest wave in 36 waves. Over here, it's the biggest wave in 32 waves and biggest volume in 49 waves. Yet, it took out the high. So this is really important to understand, that you'd be right on this trade maybe more than 6 out of 10 times. But this is the 1 in 3 or 1 in 4, which you'll be wrong in. So you cannot prevent losses. You just can't prevent losses, but you can minimize them so that over a sequence of trades, you do pretty good. All right, that's enough of the psychology part. Take care.